By late 2025, global debt crossed $346 trillion. That is more than 3 times everything the world produces in a year. Governments are in debt, corporations are in debt, households are in debt. So here is the question almost no one asks. If everyone owes money, who is lending all of it? This documentary is about answering that question. What is global debt? Before we can understand who lends money, we need to understand what global debt actually is. Global debt is not just government borrowing. It is the total amount of money borrowed by governments, corporations, financial institutions, and households worldwide. Economists usually divide global debt into 4 main categories. First, government debt. This is money borrowed by countries to fund infrastructure, defense, healthcare, and crisis response. Second, corporate debt. Companies borrow to expand operations, invest in technology, and finance growth. Third, financial sector debt. Banks and financial institutions borrow from each other to keep the system liquid. And fourth, household debt. Mortgages, student loans, auto loans, and credit cards. Together, these 4 categories pushed global debt to nearly $346 trillion by 2025. This number keeps growing because borrowing has become easier, cheaper, and more common. But debt alone does not explain the system. For every borrower, there must be a lender. The borrowers. Who is taking the debt? Debt starts with borrowers, and today, borrowing exists at every level of the economy. The United States is the largest borrower in the world. Its national debt exceeds $38 trillion. But governments are only one part of the story. Corporations borrow trillions to invest in technology, energy, manufacturing, and research. Households borrow as well. In the United States alone, household debt exceeds $17 trillion. Mortgages make up the largest share, followed by student loans, auto loans, and credit cards. Debt itself is not a problem. It allows economies to grow, businesses to innovate, and families to buy homes. The danger appears when debt grows faster than income and economic output. Today, global debt exceeds 330% of world GDP. History shows that when debt becomes too concentrated, the system becomes fragile. And that brings us to the next question. If borrowers are everywhere, who is lending all this money? Lenders. Who is providing the money? Here is the most important idea in this documentary. Every dollar of debt is someone else's asset. When governments borrow, investors buy their bonds. When companies issue debt, lenders expect interest in return. When households take loans, banks provide the capital. So who are the lenders? First, ordinary people. Americans lend money through retirement accounts, pension funds, insurance policies, and mutual funds. When a pension fund buys U.S. Treasury bonds, it is lending money to the federal government. Next, banks. Commercial banks create money by issuing loans. A deposit becomes a loan, and a loan becomes new money in the system. Then there are central banks. The Federal Reserve creates money by purchasing government bonds, especially during crises. This makes the central bank the lender of last resort. Foreign governments also play a role. Countries and sovereign wealth funds hold trillions of dollars in U.S. debt. And finally, private investors. Hedge funds and asset managers lend globally in search of higher returns. When you connect all of this together, one fact becomes clear. There is no single lender. The lender is the global financial system itself. How the system works. Money creation and the debt cycle. So why does this system not collapse immediately? The answer lies in how money is created. When banks lend, they do not transfer existing money. They create new money by issuing credit. This expands the money supply and fuels economic activity. As long as economies grow, borrowers can repay loans with interest. But the system depends on continuous growth. If growth slows, debt becomes harder to service. Rising interest rates increase pressure on borrowers. This is when defaults begin to appear. Debt does not disappear. It shifts risk from one part of the system to another. When debt becomes dangerous. High debt levels increase vulnerability. When interest rates rise, governments spend more on debt payments. Corporations cut investment. Households reduce spending. This slows the economy. The 2008 financial crisis followed this pattern. Too much debt concentrated in one sector triggered a global collapse. Today, policymakers closely monitor debt to GDP ratios and interest costs. Debt is manageable until it is not. What global debt means for ordinary people. Global debt is not abstract. It affects interest rates on mortgages and credit cards. It influences inflation and the cost of living. It shapes government budgets, taxes, and public services. Even if you never borrow money, debt still affects your life. So, who lends all the money when everyone is in debt? The answer is simple but uncomfortable. We lend to ourselves through systems, institutions, and financial cycles. Debt powers the global economy, but balance determines whether it builds prosperity or creates crisis. This is not just about numbers on a screen. It is about the system that shapes our future. If you found this documentary valuable, take a moment to like the video. It helps more people discover this content. Subscribe to the channel for clear, unbiased explanations of how the global financial system really works. And share your thoughts in the comments. Your perspective is part of the conversation. Thank you for watching.